This conference will now be recorded.
Yes, Sukhbir bhai, how's it going? Lovely. So this has been one of my most inspiring videos. Welcome, my friends. This is your life. So what's important is the power of choice. What type of picture you want to make, right? Right. Is my voice clear? Can everyone hear me? Can everyone see the screen? Good. Right. So it's revision time. You remember we did futures and then we did options. What were options? The owner the right to buy or sell securities at an agreed upon price by paying a certain amount as premium, but he's not obligated. Having the right in case of profits if it goes above the strike price, but not the obligation in case if it remains below the strike price. Similarly, the seller on the receipt of premium loses the right but is obligated to buy if the buyer so demands. So the buyer pays the premium, he has the right but not the obligation. So he has limited risk. Okay, he has the right but not the obligation, means limited risk. Point number 3, has unlimited profits. So we all know this. So seller, he receives the premium, does not have the right but is obligated. So the sellers, so who is a buyer of a call and a seller of a call? Buyer is the person who pays the premium to the seller. Premium at the time of doing the transaction. Underlying asset, we all know, Bank Nifty options. The underlying is Bank Nifty spot. Strike price, the price at which the asset or underlying instrument can be bought in case of call or can be sold in case of put. That is called the strike price or exercise price. So if my friend Avinash sir has bought a 15,800 strike call, it means that he has a right to exercise. That means only above 15,800 underlying price will he exercise the right. Am I clear with this? Any questions here? Good. No, Vikesh bhai, the market is very liquid. When you come down to the live session, we will show you that if you are a seller of a call, there are enough buyers. If you're a buyer of a call, there are enough sellers. It can be on the profit or the loss, that is separate. When you have bought and if you are at a loss, the call price is down, right? But you can always exit anytime. Expiration date, last day of the option. So the expiration date generally is for the stock options last Thursday. But I told you for index options, we have weekly expiries, right? We have weekly expiries. Every Thursday, we have a closure of a weekly expiry. Option writer, seller of an option. We all know volume, number of transactions executed for a particular time period. The purchase by the seller, purchase by the buyer and the sale by the seller is equal to volume of 1. I think so we have discussed this, right? Open interest, number of open contracts which are open for trading. Same thing like the futures open interest. So we discussed what were European options. Only at the time when the contract closes, you can exercise cash settled or delivery bill settled in the case of index, cash settled in the case of stocks, deliverable settled, right? But in American, there is a window, as I told you, which can be exercised, or the first two features are there. You can square off anytime in the market. If not, on the last day. Before that also, once the market closes, there is an exercise window which the call buyer or the put buyer can exercise his right in that exercise window on the basis of the closing price of that day. Right? Exercise window is there for 30 minutes. Very good. Right? Good. So there are two types of options, call option and put option. So when you're a buyer and you expect the asset prices to move higher, you're a buyer of a call. The buyer of a call has the right but not an obligation. So when you're a buyer, Rohit sir, you start like this. So this is your payoff diagram. This is the price of the underlying going up. This is your profit, loss. Limited loss to the premium paid. What is your break-even point? Yeah, what is the break-even point? Yes, who will tell me? Rohit sir, break-even point. Thank you. Strike plus premium. Rohit sir, you did not revise. So till the strike price, you have limited loss to the premium paid. Moment it crosses above the strike price, your loss keeps on reducing till the break-even point. And above the break-even point, you have unlimited profits. Am I clear? Is this clear for all of you all? Good. Just see this. The losses keeps on decreasing from the strike price to the break-even point. And after the break-even point, you have unlimited profits. Now the seller of a call, same thing, strike plus premium is a break-even. Same thing like the buyer, the seller also same break-even. Here, what is the difference? Profit is limited. Loss is unlimited if the underlying goes up. Just can you see mirror opposite of the buyer of a call? Buyer of a call was like this. Seller of a call is like this. Right? Am I making sense? So when will you be a buyer of a call? Sukhbir bhai, when will you be a buyer of a call? Pramod bhai, is it just bullish? Is it just bullish? What did I tell you? Very good, Somit sir. You are very bullish and you are expecting quick movement in the next 2 to 3 days. If you are a seller of a call, you are moderately bearish to a range. You are expecting the range to remain there. Am I making sense? Am I clear? Good. So why? We will come to this right now. Why 2 to 3 days? Right? So what is the put option? The put option gives the buyer the right but not the obligation to sell a particular security at a particular price within a specified time frame. Right? So call is a right to buy. What is the put? Right to sell. Right? So Vikesh bhai, let's take an example of a call. You have purchased 15,800 call. Okay? And Ramakrishna sir has sold 15,000. Vikesh bhai has purchased. Ramakrishna sir has sold 15,800 call at 100. So Vikesh bhai, on the last day of the expiry, you will make money when it crosses 15,800 plus 100. So 15,900. Right? So this is your PF diagram, Vikesh bhai. Now Ramakrishna sir, he has sold 15,800 call. So till 15, even if Nifty closes at 15,800, Ramakrishna sir will get 100 rupees. You will lose 100 rupees. His break-even point will be, because he is receiving this 100 rupees, his break-even point is 15,800 plus 100. And if it goes up, unlimited loss. Am I making sense now? Right? Vikesh bhai, did you revise? Did you revise? Should not have been there. When you are a seller, when will you lose money? When it goes up. If you have sold 15,800 call, so here what is happening? When Nifty is going to 15,900 and above, you're going to lose money. Absolutely correct. Strike price plus premium is your break-even point. Here as a buyer, you would have made money above 15,900. As a seller, you will lose money above 15,900. Unlimited loss. So if Nifty goes to 16,400, so what will be the profit? 16,400 minus break even. 15,900. So Vikesh bhai will make 500 points. And Ramakrishna sir will lose 500 points. Why? Because here his call is sold at 15,900. And he's buying back at 16,400. Because what has happened? Call means I have got sold at 15,900. Here I bought at 15,900. So ulta ho jayega. Seller of a call means wo bech raha hai. So he's covering it at 16,400. So what is the loss? Minus 500. Vikesh bhai, did you get this? Did you get this? Absolutely correct. So he has sold this. A buyer is demanding. Uska 15,900 mein, he has sold this. So he's buying at 16,400. So his loss is minus 500. Yes, Vikesh bhai. Where are you? Please understand here, if you are a buyer, उसका ऑपोजिट होगा. दैट मींस आपका घर में माल बिक गया 15,900 में. आपने अगर 15,900 में बेच दिया और 16,400 में खरीद रहे हैं तो क्या होगा? लॉस होगा कि प्रॉफिट? Exactly. So don't confuse here. If you are a buyer, you will be a seller here. When you are a buyer of a call, you are a seller of a call. That means you are selling the 15,800 strike call at 100 rupees premium. उल्टा हो जाएगा. यहाँ पे अगर आपका प्लस हो रहा है, यहाँ पे आपका माइनस हो जाएगा. Right? I think so. You're very new to the subject. What I understand. You're very new to the subject, so you need a lot of revision. Right? So put option, right to sell, but not the obligation. Specified asset within a specified time frame. This is opposite to the call option, which means right to buy. So basically, right to sell. What happens if I am buying a 40 strike put at 4 rupees? What is it telling you? That if it goes below 40 rupees, is the noise clear? Jagat Bhai is there. Okay. If it goes below 40, this is my strike price. Below 40, right to sell, then I'm eligible to sell. So here what will be my break even point? 40 minus 4. Strike minus premium. Below that, I will have unlimited profit. Is this clear, Vikesh bhai? Vikesh bhai, now by default you become my Rajnikant. So this is a buyer of a put. Vikesh bhai, this is a buyer of a put. Now the seller of a put. So when the buyer of the put has got right to sell, what will have a seller? Seller will have a right to buy if it goes below 40. Obligation to buy, not the right. LV, the right word is obligation to buy. The right word is obligation. So if he has sold 40 strike put, that means he have received the premium. So 36 is his break-even point. So below 36, the seller of a put will have to buy. So he can have big loss till 0. Seller has an obligation to buy for the put. Am I making sense? Is this clear? Yes, Vikesh bhai, now is it clear? Good. So today, thank you for teaching me something new. Now, my friends, Ramakrishna sir, today Vikesh bhai has taught me something new. Each and every student teaches me something new. Right? So when you are a buyer of a put, what are you doing? You are very bearish. You are expecting a big fall in the next 2 to 3 days. When you are a seller of a put, you are moderately bullish to a range. Why? Because you don't expect, if you are a seller of 15,700 put, you're not expecting the markets to fall below 15,700. If it goes down, Vikesh bhai, unlimited loss. Why? Because that is the way the option products are designed. Seller has limited profits, unlimited losses. Very good. So are you clear? Buyer of a call, buyer of a put, seller of a call, seller of a put. The seller has the obligation above the strike price. So if you have sold a call of 16,000 and if Nifty crosses 16,000, the seller is obligated, right? Am I making sense? All of y'all. All of y'all. Very good. Now, my friends, did I tell you something? There are two types of premium: intrinsic value and time value. Intrinsic value is that premium which is in the price of the options, which will not change till the price of the underlying does not change. So supposing Nifty is at 15,600 and you have bought a 15,400 call strike. So whether Nifty is today's expiry on 5th of July or on the 29th of July, whenever there is an expiry, as long as the price of Nifty does not change, what will happen? What is the intrinsic value? Spot minus K. What is K? Is strike. Should be greater than 0. As long as for the call, the spot minus strike is greater than 0, it will have intrinsic value. So this is the spot price. This is the strike price. Are we all on the same page? Great. Now, my friends, call is the right to buy 15,800 put, right to sell. This is the strike. And the spot price is 15,600. So we all know for the put, right to sell, if the spot minus strike is greater than 0, it will have positive intrinsic value. Are we all clear with this? Good. Now, what is time value premium? We all know that the premium consists of two parts, intrinsic and time value. Time value premium, my friend, is an extra incentive paid by the buyer to the seller. Why? Because the seller is taking that risk. Seller is taking that risk of unlimited losses which he can incur as there is time left for expiry. As there is time left for expiry, there can be unlimited losses which the seller can incur. So if the seller is incurring unlimited losses, the buyer has to compensate. And that compensation happens in the form of time value premium. But my friends, please understand, as the time to expiry keeps reducing, the probability of the seller losing money also reduces. So as there is less time to expiry, the time value premium starts coming down. And on the last day, there is no time value premium. So they say that the option premium is like the melting ice. Okay, Rohit sir has asked a very pertinent question. Can time intrinsic value premium in the money option will have no time value premium? We will have a look, Rohit sir, right now. So as we all know that option lose time value premium. So options are like melting ice. So now do you understand, as a buyer of a call option, as the buyer of a call option, if we keep our position open for more than 2 to 3 days, what will happen? What will happen? Time value premium loss, premium will get reduced. So that is why we don't want to keep our long call or long put for more than 2 to 3 days. Now, Rohit sir, did you know, did we see this example last day? Can you see this intrinsic in the money options? All those in the money options are those strikes which have got positive intrinsic value as well as time value premium. Can you see even in the money options have time value premium? Can you notice this? Right? Now, can you see the first strike where the spot and the strike are close to each other, and the first strike after the in the money option which does not have intrinsic value premium is called at the money option. Are we clear with this? And all the other strikes far away from at the money options are called out of money option. Am I clear? money options and out of money options have no intrinsic value premium. So for calculation purpose, we keep one strike as at the money, right? We keep one strike as at the money. So 15,700 by default is the at the money strike. So if I go down to the option chain, can you see this? The dark colored ones are in the money option. First strike is called at the money. All that is a call out of money. Am I clear? Good. So now, Manju sir, how many times did you revise? Very good. I expect you to do more than once. You say when you like anything more than your life, when you enjoy something, the number becomes irrelevant. Right? So Venkatesh sir, the data is here. Go to the market data option chain. So call option, as I told you, strike greater than, sorry, spot greater than strike. Call at the money, spot equals to strike. Out of the money, spot less than strike. Put option, spot less than strike in the money. Spot equals to strike at the money, out of the money, spot greater than strike. So number of open contracts which are outstanding in futures and options market at any given point of time is called open interest. If I go down, what do I see? In options wherever there is an increase in open interest, it is assumed that the writers are increasing position, whether it is a call or a put. Why? Why? Jatin sir, why? Harish sir, why? Why it is given that when there is an increase in open interest? Lovely Chintan Bhai, how's the weather in Singapore? Very good. Please understand, as a buyer of an option, if I have bought something, I cannot lose more than the premium paid. But as a seller of an option, what happens? In case, if the market moves against me, as a call seller, if it goes above my strike price, I'm obligated for the unlimited losses. So the seller will be proactive and he will be cutting his losses in case if it goes above the strike price. Am I making sense? So this open interest importance is only seen from the seller side, right? We never assume it from the buyer side. So let us see the open interest of 8th of July. Can I see this? Where is the highest open interest? 15,800, right? Can I see on the put side, where is the highest open interest? 15,700. What do I see? That 15,800 call and 15,700 put. This is out of money strike having highest open interest. So the call will be resistance. The put will be writer, support. Right? Too narrow a range, so the market is not expecting any big movement. What else did I tell you? Which out of money strikes have the highest open interest? 15,670. Which highest out of money put strike has the highest change in open interest? 15,600. So can you see this? The writer was writing 15,600 put, highest change on a single day. All is at 15,800. Right? So we will consider both. No, market is not going to go down. Market is going to trade in between this range. So the market expectation is a very small range. So Vikesh sir, on Monday, if you see this open interest being cut, then probably this is the range of the market, 16,000 and 15,700. If you see open interest being increased here and open interest being cut here, absolutely correct, Jatin sir. Call resistance because call seller. Put support, put seller. So right now the market is in no range, uncertain. We don't know whether it will go up or down. It is looking like very narrow range. Why? Call seller 15,800, put seller 15,700. Am I making sense? Yes, option chain support and resistance. So we will learn how to predict the trend. Okay. Yes, it can move either way. Absolutely correct. Now we come down to the monthly expiry. Wow, can you look at the monthly expiry? 16,000. $15,500. Can you see this? So this is a 500 point range for the monthly expiry. 500 points range. Is this making sense? Now, my friends, I know that the highest call writing is here, right? So if I go down to the presentation, did you understand this? Out of money call and put, support and resistance. We have discussed the highest change in open interest. Find out the average price. Find out the average price of the option buyer or seller. How do I find, Abhishek sir? How do I find the average price? How can you tell me, sir, what is the average price? Yes, Abhishek, sir. When you become an analyst, you have to focus on your process. All right? You need to focus on your process. Now see the process and try to understand. How do I calculate the average price? I go and click on the LTP. Everything has importance, Manju sir. Volume is not important. First of all, the open interest is the most important, and then comes the change in open interest. Now I come down to this window. Can you see this? 16,000 call. Now I go down to the historical data. I click on the last 3 months of historical data. I click on the expiry. What is the expiry? 29th of July. I click on the call. I click on the strike. Right? And I'm downloading this. Now what do I get? I get the whole details. Can you see this? From last 3 months. Okay. Now what do I do? Manish Bhai, I showed you. Where were you, sir? I click on filter. Now I sort this out from the first date, that is the 30th of April date, to 29th of July. Are we clear till here? Right? Now what do I do? I don't want these expiry data, call options, strike. I delete this. I don't want the open price, so I delete it. I don't want the settlement. I don't want the last price, settlement price, value. All right. Now I've got open interest, change in open interest. Right. So now what do? I take out the average price. So what is the average price? High plus low plus close. Divided by 3. Lovely, Ramakrishna sir. Amazing. I take out the average price of these days. Now what do? I multiply the average price into change in OI. What is the everyday OI? So can you see this column, change in OI into average price? Okay. Now what I'll do, I'll take out the sum. And also take out the sum of the change in OI. Right? Now what is the price? 150. What is this price called? Weighted average change in OI. So what is happening to my open interest every day? Is it going up or down? Change in OI into the average price. I'm taking out the weighted average. So what do I know? That what is the current price? 77. What is the buyer and seller's average price? 150. Who is winning? Who is winning, Vikesh sir? Call seller. Why? Vikesh sir, why is the call seller winning? Vikesh sir, why is the call seller winning? Very good. The current price is below the weighted average change in open interest price. This is the average price of the buyer and seller for this expiry, right? So the price is below the average price. That means seller is at an advantage. So if it starts trading above 150, if it starts trading above 150, can you see here? From 150 it has collapsed. I will show you the chart. How many of you have a Zerodha account? Great. As I told you, sir, everything should have a process. Without a process, you cannot make money. If I take every day's average, I will not get the right picture. This is the chart of 16,000 call, right? So what is the average price? $150. This is the line. Only if it's for me, even 150 is just the average. The sellers will not be in a rush to cover. The sellers will start covering only if it goes above 20 rupees higher. So currently I see the sellers are winning. Can you see this? Did you understand? So your homework for today, before I take you step by step, how did we get this? Manish bhai, are you there? Listen carefully. I go down to the option chain, 29th of July. I go down to the strike with the highest open interest out of money, 16,000. I click on the LTP price. Right? Now I go down, click on the historical data. Right? I go and click on 3 months. Okay? I will go and click on the expiry, 29 July. Option type call. 16,000. I will download this. Right? So once I download this, what do I get? I will get this data. So I will click here, filter this, sort this from the starting date. I will remove, I will have high, low, close, right? Manish bhai, weekly expiry does not have the data, so you have to do monthly. Weekly expiry just has very small database, so you can't get the real picture. So now my friends, what am I doing? This sheet I will be sending this to you all. What is your homework? Your homework is same exercise for the put. What is a put? 15,500. Same way which you took out for the call. This is not called VAP. This is called weighted average change in open interest price. It is not volume. It is change in open interest. Am I making sense? Is this clear? So now I've taught you one more tool. So now you know that if 16,000 call is going to trade above 150, you know that the buyer will win. 15,500 is good. Highest is 15,500. I think so. That's good enough. Let's not focus on 15,000. Too far away. Right? Is this clear? Open interest in option is the summary of the options and buyers and sellers in the markets, which reflect the market sentiment in total and needs to be worked upon with future open interest along with price action to understand the holistic picture. So do you understand this? How did we find the support? We found the resistance, average traded price, change in open interest in which strikes. So we did the Bhav copy. It was a compilation of the day open, day high, day low, and day close prices of all stocks. It includes the volume and the values along with delivery and open interest for cash and derivative segments. So this is the base for all research, the Bhav copy. Right? Now we come down to one of the most important part. Vikesh sir said, how do I get to know the trend? Who is winning? Option chain only, the put call tells me only about the resistance and the support. Highest out of money. But who is winning? The buyer or the seller? How do I get to know? We will come to know through this put call ratio. The put call ratio is a popular tool used by investor to gauge the overall market sentiment. It is used to gauge the overall market sentiment. The ratio tells us how much put writers are there compared to call option writers. We all know now that this put option is seen in terms of writers, not as term of buyers. Do you know this? Are we all on the same page? This put options are seen in eyes of writers, not in eyes of buyers. This call options are seen in eyes of writers, not in eyes of buyers. So if we are seeing this, can you see at the end, I have got the total put writing 3,63,215. Can you see at the end, I've got this total call writing 4,51. So what do I mean by put call ratio? Total number of put divided by total number of call. 3.6 4.63 divided by 4.51. What is the put call ratio? Very good. 3.63 divided by 4.51. 0.80. Now this number has a significance, my friends. So generally it has been seen that the obvious range is between, the normal range is between 0.5 to 1.5 or 1.6. This has been the general range. For every put, how much calls are written? Right? That is the put call ratio. Right? Now, there is a simple thumb rule for indexes. Please listen very carefully. When the put call ratio is between 0.9 to 1.1, it means that the market is neutral. What does it mean? Market is neutral. When the put call ratio is greater than 1.1, that means there are more puts written compared to call. It means it is bullish. It means it is bullish. Now, my friends, Nifty is at 15,900. Nifty goes to 16,400. 300, 400 points it has gone up. The put call ratio from 1.1, it has gone up to 1.2, and at 16,400 it is 1.5. What does this mean? For every 1.5 calls, there is one put written. That means, sorry, for every one call, there is 1.5 puts written. That means the put writers are 50% more than the call writer. So when the put call ratio is 1.5, that means for every one call, there is 1.5 puts written. Right? So the put writer is 50% more than the call writers. Very good. But the market, Ramakrishna sir, has already gone up. So in an up market, when there are so many people who believe that the market is still going to be bullish, what happens? In case if the market falls, what will happen? All these put writers, they have to cover. If they run to cover, what will happen? Market will fall more. So when the market has gone up and put call ratio is 1.55 and more, so the condition is that the market is flat. If Nifty is at 15 and 15,900, market has not gone up. So in here, if there is a higher put call ratio, no problem. It means they're expecting markets to go up. But if the market has already gone up and you see this put call ratio, what do you understand? You understand that there are a lot of people who are writing puts compared to call. They are expecting markets to go up from here, which is not happening. If it does not go up and it falls, those people who have bought more, who have written more put, they will rush to cover. Am I making sense? So let us do once again. What is the put call ratio? number of puts written to the number of calls written. This is called put call ratio. Total number of puts divided by total number of calls. So for every one call, how much are the put written is called put call ratio. So when this ratio is greater than 1.1, that means for every one call there is 1.1 put written. It is more puts, so it is bullish, because we see this in the writer scenario. But sometimes when the market goes up, say 400 to 500 points in Nifty, it's already gone up, and now you've got extreme put call ratio. What is extreme? For every one call there is 1.15 put written. That is called put call ratio. That means the people are expecting markets to go up more. People are expecting markets to go up more. It's already gone up from 15,800 to 16,400. It's already gone up. But people are expecting markets to go up more. Right? In case if the market does not go up and if the market falls, so can you see when the put call ratio is 1.55, expect reversal if the market has run up. If the market has gone up, there are chances if the reversal happens, it will be very quick. Yeah, this is used for weekly expiry also. Is this clear now? Neutral 0.9 to 1.11. Right? Yeah, this is applicable for Bank Nifty also. Above 1.1 bullish, below 0.9 it is bearish. Below 0.9 it is bearish. So once if the put call ratio falls 0.9, it is bearish. So Vikesh sir, what is the put call ratio right now? Vikesh sir, what did we do? 3.63 divided by 4.5, 0.8. Is it less than 0.8? 0.9? So the put call ratio is bearish. Please understand, this is a live concept. This is a live concept. In this live concept, the put call ratios are continuously changing in the market. Yeah, this is for all strikes. So the put call ratio needs to be monitored. We need to be monitored. Right? So it's a live concept. So we have a live market class on Friday. Are you all aware? In this live market, I'm going to show you how you need to monitor this ratio every 20 to 30 minutes. Vikesh bhai, it will be on Friday. Okay? Yeah, I think so. There is a mistake from the side. They have not rectified. I will tell them to rectify that. Okay, we will make it on Wednesday. Don't worry. Don't put in too much of pressure, sir. We'll make it on Wednesday. Don't worry at all. Anything for my students? Oh, you haven't taken off. Thank you, sir. Then we will take on Friday, sir. Take a leave on Friday. All of us. Right? 0.8. Now, my friends, if the market has fallen 500 points and the put call ratio is 0.6, that means for every one call there is only 0.6 put. Right? For every one call there is 0.6 put. So the number of call writers are huge compared to number of put writers. So everybody is expecting the market to fall, but the market has already fallen. Market has already fallen. So in this scenario, in case if the market reverses, the call writers will rush to cover. So expect market reversal if it has already fallen and the put call ratio is below 0.65. So this becomes a contrarian indicator. Are you getting this? So when the put call ratio, so you can't anticipate. रोहित भाई आपको प्राइस एक्शन से पकड़ना पड़ेगा. अगर मार्केट घूम रहा है तब contrarian indicator. Are we all on the same page? So Vikesh bhai, is your question answered? How will you get to know the trend? Bearish, bullish, neutral? 0.9 to 1.1. Neutral, greater than 1.1 buy. But if the market has already gone up, and if the put call ratio is 1.55, and if it reverses, Rohit bhai, only it should reverse. Then the reversal will be sharp. Below 0.9, sell. Right? But if the market has already fallen and put call is 0.6, expect the reversal if it has already fallen. Expect a reversal if it has already fallen. Am I making sense? Is this clear? Any questions? So don't worry. We're going to see the practical class and understand. So what are the things you need to look? Open interest. विकेश भाई ये बड़ा ट्रेंड देता है, आपको एंट्री एग्जिट अपना टेक्निकल एनालिसिस से निकालना होगा. ये आपको ये नहीं बोल रहा कि आप पेश के भूल जाइए. What it tells you? No, Ramakrishna sir, never. Highest I have seen is 1.7. In my track record, highest 1.7, lowest 0.45. I haven't gone beyond this. Right? No, Manish bhai, weekly options have more open interest than monthly. So weekly is more important. If you see here, and you see here, what is the open interest? 3,63,000, 4,51,000. If I go down to the monthly, open interest is much lower. Oh, here monthly is also decent. 5,13,000, 4,02,000. So you can take the monthly also. So if I take this, what is the monthly open interest? 513 divided by 4. What is it telling you? 1.2. So monthly, you are bullish. Weekly, you are bearish. So if I combine the both, what do I get? Neutral open interest. What do I get? Open interest. Put call ratio, neutral. Right? Is this clear? Range bound. So 16,000, 15,500. Answer is clear. So in case now if the weekly becomes neutral, no, it's not volatile, it's a range bound. It's not volatile, range bound. Right? Average price cannot be calculated on weekly. Data ही नहीं है, 10 दिन उसका liquidity नहीं रहता. There is no liquidity. Right? In index, it is seen. Yeah, we will talk about the VIX later on. Later chapter. Right? In stock option, this principle is not applicable. Can you tell me why? In stock option, why this principle is not applicable? Right? Why? Okay, so let us see. Let's take an example of Reliance, very liquid. Right? It's a liquid stock option. So Avinash sir said stock options are not liquid. We know that Reliance options are very liquid. Very liquid. Can you see? Huge liquidity. Can you see the difference between bid and ask? 20 paisa. 20 paisa. Right? It's very liquid. Now let me see the open interest of the call. 1.48 lakhs. Let me see the open interest of the put. 0.62. So I am noticing that in stock options, the open interest of call is much higher than the open interest of put. Open interest of call is much higher than the open interest of put. The reason is, how many of you know that there is something called covered call? I have Reliance Delivery and I'm selling the call to earn it. Yeah, Ramakrishna sir, we will learn. Don't worry. In generally what we have seen in stock options, open interest is higher in call than in put. One reason which can be attributed to this is the covered call position, which is undertaken by the market players. So this put call ratio does not show the right picture. Like we've been able to segregate. Let us have a look at Bank Nifty options. We can do the same thing which we did at Nifty. But we can't do the same thing for index. If I see the Bank Nifty option, same thing. 3,68,000, 4,64,000. .80, same, right? So if I take down to the monthly option, रविंद्र सर, स्टॉक्स में कवर्ड कॉल होता है. There is covered call, which we will discuss that. Against my holding, I am selling a call to generate some income. Can you see the Bank Nifty open interest in the monthly expiry is very low compared to Nifty. So I will ignore. So Bank Nifty is definitely a sell. Right? So Bank Nifty is definitely a sell. Is this clear? So very interesting. Monday global markets are very strong. Yeah. Sumit sir, I will explain this when we do covered call. Don't worry. We'll do it later on. So let us revise once. What is put call ratio? Total number of puts by total number of call. For every single call, how much put is written? What is neutral? 0.9 to 1.1. Above 1.1 bullish, below 0.9 bearish. So greater than 1.1 bullish, below 0.9 bearish. When is contrarian? Market has gone up, put call ratio is 1.5. In case if it reverses, the reversal will be more. This is contrarian. For the downside, market has fallen 0.65. Put call ratio, if it reverses, only if it reverses. Lot of times it can still keep falling. Lot of time it can keep still rising. So lot of people what they say, sir, you told me 1.5, I have sold the market. Don't make that mistake. Right? Yeah, Ravindra sir, all these three things are going to help you in the live market to find out the trend. Am I clear? Is this clear? Who has not understood? Manish bhai, I have not understood your question still. Please explain it to me. I am very poor in studies. So we did option chain, matrix, listing the details of the call and put. Right? Can you see the call put? Open interest, change in open interest. We will do the IV later on. Volume, bid and ask, this option premium traded for a particular expiry, a particular instrument. The various strikes, right? It gives you a holistic picture of what is happening in the markets. It gives you a holistic picture what is happening in the market. Champak Bhai said, how do I come to know how will the weighted open? Very simple. If I know that 16,000 call writer has the highest open interest, right? And the price, the seller is winning. What does it tell you? Very simple. Till 150 is not crossed and sustained in this strike price, markets will not go up. Till 150 is not crossed and sustained, markets are not going to go up. So the call writer is going to defend 150 rupees on the 16,000 call. Lovely, Champagai, you've answered the question yourself. Lovely. Are we all set? So how do you do your research? Price action. I did not take 3 months data. Which 3 months data are you talking about? Are nahi sir, acha, you are taking a time period. Why did I take the 3 months data? Because if you see this example, major data increase took place only in this month only. Can you see? Can you see the open interest? वो जून से ही बढ़ा है. But when I'm taking the 3 months, I'm covering the total open interest. So it will give me a more realistic picture than the 1 month data. Can you see it's covering the total open interest? Can you see it's starting? So it will give me a more accurate data, right? It will give me a more accurate data. Good. So how do you do your research? I think so most of you guys already know it. Price study, direction of the instrument, range bound, future open interest, cash market delivery studies. Then you have the open interest option, which I've told you. Champak bhai, we'll come to the strategy later on. Too early. It's all too early. This is just an indication, right? Pricing of options, option chain. Breadth studies helps you to understand market buying or selling is broad based or not. Right, so Vivek sir has done RS with all of you. Have you all done RS? This is actually breadth studies, comparing of a stock to an index or a sector or other stock. It's called breadth studies. So this is the flow of research: price study, future open interest, option open interest, breadth studies. Champak bhai, tomorrow I understand that you want to basically you want to trade and you want to make a living out of it. So tomorrow we are going to discuss that strategy which all my students are trading, which is called the Golden Bank Nifty strategy. Right? So from probably Friday onwards, you will start receiving that strategy in the TMP group. Right? Vinay will give you, already other TMP groups are already receiving. So we'll discuss that strategy tomorrow. Any questions? Rohit sir, it is seen as a percentage. अगर 3 रुपया का कॉल है और उसमें 30 पैसा बहुत ज्यादा है. If it is a 300 rupees premium and if it is 1 rupee, it is okay, fine. Right? Please understand the price. Vikesh bhai, have you not done the revision? Have you forgotten? Price up, open interest up. What is it? What is it? So this is futures. Options, what did you? Very good. Don't confuse me. I get scared. Sumit sir, there is something called strategy. Manual strategy. What is a manual strategy? I have decided on the parameters before. If all my parameters are met, I will take a trade. And there is something called analytical strategy where you are deciding on the trade on the basis of the live market data. That is analytical. So everybody has his own strength, right? So we are going to do that. सुधांशु सर, हम लोग का पहला क्लास टेक्निकल का चालू हुआ था, right? You remember tomato, prices of tomato, bid and ask. So if the bid and ask is very narrow to each other, close to each other, that means the liquidity is high. If the bid and ask is far away from each other, that means the liquidity is low. Right? हाँ प्रमोद सर, आपको रिवाइज करना होगा सर. You need to revise. Right? No, that's nothing to do with volatility. Liquidity has nothing to do with volatility. No, basically if you want to know the trend, if you see a stock is a breakout with high future OI, long build up, then I can be a buyer of a call. If I see a stock is giving a breakout with long high OI, then what will I do? Because sir, I can use that in option. I can be a buyer of a call. Right? Good. So in stocks, futures are more important than options. Why? Options I showed you in stocks, they are not very liquid. Only certain stocks have liquidity in options. Am I making sense? Good. Any other questions? So Ramakrishna sir, I think so Sorodeep sir is helping you with false breakouts. So breakouts, the important thing is to understand the point of the breakout. So breakout is a misused term. Breakout is a misused term, right? So there is a concept in technicals. So what are the concepts? One is a range market. One is an upward trending market. One is a downward trending market. Right? A range market is where the market has established a broader resistance and support. Right? Consolidation. Upward trending market is whether the base is up, but there are narrow consolidations which are time-based in nature before the fresh breakout takes place. A perfect case example is Infosys. Right? If you see this Infosys stock, what do you do? What do you see? It is always near to its 52-week high. Can you see? It formed a consolidation range, but near to the 52-week high. So when it broke out, here you got the momentum. So now the problem here is, Ramakrishna sir, we are finding a breakout here. We are finding a breakout here. So what happens? Human mind tends to find a lot of entries. So when you try to find a lot of entries at a lot of places, you will go wrong. Because Infosys is in a broad range here. Till it does not move out here, you will not make money. So that is why a lot of false breakout happens. That is why a lot of false breakout happens. Right? In a range. That is why a lot of people have lost money in Reliance, because Reliance is still in a range. It has not moved out. Can you see this? In the past 1 year, it is still in a range. Right? Now, if you try to make money here, you cannot make big money. A lot of breakouts have gone false. Can you see here? It broke out, again it has come back. Can you see here? It broke out here. Again it has come back. Why? Because the broader structure is in a range. If the broader structure is in a range, until unless it does not move out of this band, you're not able to do anything. So now have you understood your question, why there are a lot of false breakouts? Because what you perceive as a breakout is never a breakout, it's a broad range. So always avoid stocks which are in a consolidation phase. Try to enter stocks which are already showing you movement, which Surodeep sir is very famous for. He finds stocks which are giving directional movement, so he makes enough money. So I was tracking a stock which was SRF. So please read the mind of Surodeep sir. Just see this. This never went into a range. Can you see this? It was a breakout consolidation, but it never went into a flattish range. It is making a higher high again. Right? So when it does not get into a range, that is a very good sign. Right? So now see this breakout support and it has gone up. So important thing is if it becomes flattish, then you have to avoid being in the market. Right? Is this clear? So stock selection is very important. If your stock selection is poor, if you had bought Reliance in the last 1 year, you have lost money. If you're looking at Bank Nifty, well, the rally was in mid-cap stocks. Story is over because Bank Nifty is already in a range. So you can never make big money right now till it does not move out of the range. Right? Can you see this? It has done nothing since March. And can you see the candle size? It is getting smaller. So can you see it's a very clear broad range. So till I don't see this moving out. So for me, this is the broad range. 33,361 in 36,000. Don't see anything happening. Am I making sense? You can, depending. You can. If you want to be a long-term trader, yes. You have to be a trend follower. So those people who are still in Infosys, they have not exited. Because Infosys trend is still up. It has not gone into a very big range. Yeah, we'll come to what we can do regarding options. We are just talking about basic things. Right? So Bank Nifty is still in a range. Nothing can be done. Right? Any other questions? No, Bank Nifty does not have a cup and handle pattern. Nothing. Right? It does not have any cup and handle. It is fully in a range. Right? Right? Good. So what we need to do is now take a break. Nifty is nothing in a range. Nifty is in a much better position. Oh, it's gone into a range. Yeah. Very much into a range. Very much. Or just about to enter a range. Nifty is just about to enter a range. Right? Within the next few days, it can. The characteristic looks like a range of 15,500 and 16,000. Right? It's a clear range, 15,500 and 16,000. Right? Yes. Good. 11:05 by my watch. Please take a break. See you at 11:15. Right? See you at 11:15.
आवाज आपने बंद की है ऐसे।
Welcome back. Is your break done? Good. So please check your WhatsApp group. Have you received the file? Good. So the homework is 15,500 put. Same way, I've shared the file. We're going to do the same way. So now we are entering into the world of option Greeks. The trading rules that I live by are cut losses, ride winners, keep bet small, follow the rules without question, know when to break the rules. So this is done by Ed Sipketa. He's a market wizard. Cut losses, ride winners, keep bet small, follow the rules without question, know when to break the rules. So my friends, theoretical pricing of options. You remember we did the theoretical pricing of futures? Now we're going to do the theoretical pricing of options. There is a mathematical model known by the name of Black-Scholes. In that model, you have to put these following inputs: underlying price, strike price, number of days to expiration, implied volatility, interest rate, right? Underlying price, strike price, number of days to expiration, implied volatility, and interest rate. So my friends, there is a website by the name of options/price.com. Options/price.com. When I go to this website, now my friends, I want to know $15,800 call. What is the price? If I go down here to the option chain, right? What is the spot price of Nifty? 15,722. So the underlying price is 15,722. I want to know what can be the theoretical price of options. So I'm taking the 15,800 call strike. I'm putting it into the calculator. My friends, if the expiry is on the 8th, how many days are remaining? So Friday was the last trading session. Saturday, Sunday, Monday, Tuesday, Wednesday, Thursday. How many? 6. 6 remaining. So please see from the last trading session, even if today is Sunday, till Monday does not start, we will have 6. Am I clear? From Monday, then we will have 4. Monday evening, only 3. Tuesday, Wednesday, Thursday. Tuesday evening, 2. Wednesday, Thursday. Wednesday evening, 1. Only Thursday. Am I clear? Are we all on the same page? 6. Interest rate, what is it? Roughly about 6.5, right? On an average, dividend is 1%. Index dividend is 1%. So that's assumed, right? Now this volatility we don't know. Rounding off means decimal numbers, 3 decimals, and graph increment not for our use. Now this volatility we don't know. Now my friends, how do I solve it? We all know that volatility is in the price of options, right? Volatility is in the price of options. So what do? I assume a number, right? I assume a number, 10. I get a value of 52. Now what will I do? I will try to match Can you see the 15,800 call? It's near 46. What was the last traded price? 46. So I will try to match the call price along with the theoretical price along with the last traded price. I will try to match the theoretical price with the last traded price, right? What do? So the theoretical price is 52 and the last traded price is 46. So let me increase this volatility. Oh my God, the value has gone up. I wanted the value to be down. No, interest rate is fixed because interest rate does not change, 6.5. So let me reduce. रोहित सर एक साल में पैसा रखते हो तो कितना परसेंट मिलता है बैंक? रिस्क फ्री रेट ऑफ इंटरेस्ट कितना है? Let me reduce to 10.4 is 55. So let me make it 9.5. Very close. Can you see this? Let me make it 9.3. We are close, right? So this IV, we will come to know when I match the theoretical price of call option with the market price. I know all the inputs, underlying price, exercise price, number of days to expiration, interest rate, but only the volatility portion I do not know. So how do I calculate? I put in this formula in the Black-Scholes. I try to match the theoretical volatility with the last traded price in the market. And when I match it, this is the IV, right? So 1 or 2 rupees here or there is different. Now someone told me, sir, you don't have to do all this. NSE has volatility here, right? Now my friends, NSE also calculates with this calculator. Can you see they have taken 10% as interest rate? They are mentioning. So NSE does not have the IV themselves. They are also using the calculator to find it. Am I making sense? Their calculation is a little wrong, Kishan Bhai. How are you, Kishan bhai? What did you have for breakfast? Today you have become very quiet. So NSE people have not changed interest rates. Am I making sense? Are we on the same page? So what is the use of the calculator? The calculator tells you the theoretical price. We all know this IV is inside the price of options. So when I match the theoretical price with the current price of options, I get to know the IV. This IV is called implied volatility. Am I clear with it? So Ramakrishna sir, if you change the input, the IV will change. Right? If you change the inputs, the IV will change. So here they are taking 10%. That is why the IV is little lesser. If they take 6%, their IV will also go up. Are we all very clear with this? Srivastav sir, am I making sense? Where are you from, Srivastav sir? How has been your revision going? Very good, sir. Vikesh bhai, we will discuss that later on. It is one of the Greeks. It changes the option premium. We will discuss all these factors. Yes, this calculator is universal. Abhinay sir is saying कौन सा IV follow करना है. आप NSE का करिए, कोई प्रॉब्लम नहीं है. हर एक जगह पे IV डिफरेंट रहेगा. 19-20 का फर्क है. अपना IV कितना होगा? कैलकुलेटर से एग्जैक्ट वैल्यू कितना में आएगा? लेट अस कैलकुलेट. So let me put this at 9. So ours is 8.9. If you see, our IV will be 8.85. And NSE IV could be 8.6. Not a major difference, Abhinav sir. 19-20 का difference है. So no IV is going to be the same. So whichever IV you follow, if you're following from NSE, do that. If you're following from iCharts, follow IV from there. Right? Am I clear, Abhinav sir? Right. So what are Greeks? Greeks are collectively value. IVs can never be zero. Very good. Ramakrishna sir. Inputs will be different. They are taking 10% interest rate. Right now it's 6%, 6.5. Greeks are collectively the statistical value which measures the risk in option price. What will happen to my option premium, whether it will go up or down with respect to change in variables, is called Greeks. Please don't get worried by these terms, right? Because I'm also a very poor student. If I am able to understand it, you all can understand. Respect to change in certain variables. What are they? Delta, vega, theta, gamma, rho. So now let us do step by step. What is delta? Delta is the most popular Greek. And it measures the change in option prices with respect to change in underlying asset, assuming all other Greek variables remaining the same. So my friend Vikesh bhai has bought 15,700 coal. right? He has bought 15,700 call at 80 rupees. Now Nifty goes up by 30 points. What happens to his call? Will it go up or fall? बढ़ेगा कि घटेगा? अगर निफ्टी बढ़ता है तो बढ़ेगा? How much will it go up? सिद्धार्थ भाई, कितना बढ़ेगा? वो मेरे को डेल्टा बताएगा. How much will my option premium go up for every 1 point change in underlying, either positive or negative? What will be my change in option premium, assuming all other Greeks are same? Vikesh bhai, let's not get excited. Let's go slowly. Let's enjoy this journey. Right? See, a lot of people make money in life, but 90% of the people don't enjoy that journey of making money. Right? Let's understand this. Let's enjoy this. Like a student, young student who gets excited. Let's get that excitement on. So the delta of a call option is between 0 and 1. Delta of a put option is between 0 to -1. Right? Manjunath sir, he has purchased the call option. What will happen if Nifty goes up? Yes, Manjunath sir, if Nifty goes up and you purchase the call option, what will happen? Will the call go up? Manjunath sir, are you there? I think so, sir is in office. Manjunath sir, if the call option you have bought goes up, will you make money? Will you lose money or make money? Will you be in a profit or a loss? So can you see Manjunath sir's profit is in the same direction as Nifty movement? Abhinav sir, you have bought a call. Nifty goes down. What will happen to the call? Yes, Abhinav sir. Will the call go up? Abhinav sir, will the call go up or will the call fall? Okay, the call falls. Why? Because Nifty is falling. So Abhinav sir, will you make a profit or a loss? Loss? Same direction. So can you see when you're buying a call, your movement of the underline and your profit, same direction. Same direction. That is why they say delta of a call option is positive. Now are you understanding why the delta of a call option is positive? Same direction. OP sir, you have purchased the put. Nifty goes up. OP sir, what will happen to your put? What will be the put? Put will go up in value or come down? Put will fall. OP sir, will you make profit or loss? Loss. Somit sir, you have purchased a put. Nifty goes down. what will happen to your put? Will it come down or go up? Will you make a profit? Opposite direction. Can you see the movement of Nifty and your profit and loss is in the opposite direction? The delta of the put option is negative. Now do you understand why the delta of the put option is negative? Opposite direction, Nifty movement or the underlying movement and your profit and loss. Are we all on the same page? Are we all clear? Prashant sir, are you clear? हारना नहीं है. None of us we have to lose. We have to enjoy. We are here to learn. And we will learn. Might be it might come after a revision. It might come after seeing the video one more time. But we are not going to give up. Whatever so be. Yes, Prashant sir, are you there? Jatin sir, Jagat sir, Pramod sir, are you there? प्रमोद सर, लड़ना है, हार नहीं मानना है. Very good. Very good question asked by Rohit sir. Rohit sir has bought a 15,700 call. At the money, Nifty bhi chal raha hai 15,700. Nifty is moving. When the strike and the spot are the same, it is called at the money. Right? He has bought it at 50 rupees. The call. Now Nifty goes up by 100 points. Can you see the delta here? 0.5. What does it tell you? For every 1 point Nifty goes up, my call option will go up by 50 paisa. For every 100 points that Nifty goes up, my call option will go up by how much? 50 rupees. So what is my premium? 50. What will be my new premium? 50 plus change in premium. So my new premium will be 100 rupees. 100 होगा. मनीष भाई, 50 रुपया का प्रीमियम, निफ्टी 100 पॉइंट बढ़ा, मेरा ऑप्शन 1 पॉइंट निफ्टी बढ़ने से 50 पैसा बढ़ा, 100 पॉइंट बढ़ने से 50 रुपया बढ़ा. पहले 50 का प्रीमियम था, चेंज इन प्रीमियम 50 हुआ, 100 हुआ. Did you understand? We will come to that later. So at the money strikes, we'll have delta for the call 0.5. Lovely, Sobit sir. That is why we learn Greeks. We want to predict what will happen to my option premium if Nifty moves up or down, or Reliance moves up or down by certain points. So the delta of at the money call 0.5, delta of at the money put minus 0.5. Right? Am I making sense? Now, from at the money, when you go to in the money, can you see the delta is going up towards 1? Slightly in the money, 0.6 minus 0.6. Avinash sir, are you there? When you are going towards in the money, deep in the money, can you see the maximum it goes up to 1? Why or minus 1? How much does Nifty or Reliance move maximum? 1 point? 1 point? Does it maximum move by 1 point? If the spot can move maximum by 1 point, can the option move more than 1 point? No. Rohit sir, can it move up by more than 1 point? If the spot is moving by 1 point. Rohit sir, if Reliance spot is moving by 1 point, can Reliance future move by more than 1 point? No, because we know the spot and the future is going to close at the same point. So this 1 and minus 1, so always remember, option premium cannot rise by more than 1 point for deep in the money call or deep in the money. Maximum 1 point it can move. For every 1 point rise in Nifty, it can move by 1 point only. So that is why the delta of a call option highest is 1, for the put minus 1. Now, can the premium go to negative, Rohit sir? Can the premium be minus 5, minus 10? Option premium. Maximum it can go down is 0. Maximum 0. So that is why the delta of the call is between 0 and 1. Put is 0 and minus 1. Am I clear? Now, when you are going to out of money call, can you see it is moving towards 0? It is falling below 0.543, right? If you're going down the put out of money, can you see it is falling towards 0? Always remember there are 3 rules in delta. What are the first rule? Add the money call and put 0.5 or 0. minus 5, near to that. When you are going towards in the money call, you are going towards 1 or minus 1. When you are going towards out of money call, you are going towards 0 for both the call and the put. Are we all on the same page? Am I making sense? At the money, in the money, out of the money. You remember how did we calculate in the money for call, Pramod bhai? What is the formula? Spot greater than strike in the money. You remember? For the put, strike greater than spot in the money. At the money, strike equals to spot. You remember? जतिन भाई एक चीज ख्याल रखिएगा, even if God comes in and if he tells you sir ये कैसे है, don't believe God. Always verify, validate. I told you at the money has 0.5. You believed me, delta. You did not question me. Why? All the 47 of you did not question me. You all believed me. What was the reason for believing me? Am I God? I can mislead you. Why did you believe me? Why? Ramakrishna sir, why did you believe me? So from next time, no one believes me. You have to question me. You have to question everyone, each and every mentor. Even God you have to question when it is related to finance. Am I clear? Good. So let me prove it to you. Anything without proof is useless. There is something called option strategies I showed you. Ramakrishna sir, this is what I'm going to show you right now. You believed me, which was wrong. You should not have believed me. So I'm taking the various calls. I'm taking the various strikes which are in the money, at the money, and out of the money. There are no exceptions. Whatever the three rules I've taught you, they are sacrosanct. They are sacrosanct. They will work everywhere. So now, my friends, can you see I've taken in the money, at the money, out of the money. Now, can you see this graph? Can you see this Greeks here, delta? Can you see at the money, delta 0.5? Can you see as you're going towards in the money, delta is 1. As you're going out of the money, the delta is going towards 0. At the money, delta 0.5. Can you see that? Have I proved it to you? At the money, delta 0.5. In the money, going towards 1. Out of the money, going towards 0. What does it mean? That if you bought a 15,400 call and Nifty goes up by 1 point, my call will go up by 75 paisa. If Nifty falls by 1 point, my call will premium will go down by 75 paisa. Is this making sense? If I have bought a 16,000 call and Nifty goes up by 10 points, my call will only go up by 2.9 rupees, 16,000 call. Delta is only 29.29. Rohit sir, am I making sense? Am I clear? Now the same thing, I will show you to you input, Avinash sir. So delta will slowly move up from 0.5 to 0.55 as you are going towards in the money. Manju sir, Manjunath sir, profit and loss is different. We'll come to that later on. We are understanding the basics, right? So let us understand the basics of delta. Now I am taking you towards the put. What's your good name, user sir? Now can you see the put? At the money put, delta 0.5. minus 0.5. As you go towards in the money, minus 1. As you go towards out of the money, 0. Can you see this? How I proved it to you? Add the money, call and put delta 0.5 minus 0.5. Is this making sense now? Good. So next time, Subramaniam sir, even if God comes, do not believe him. Yeah, Chintan bhai, I told you the 3 rules. Add the money, 0.5 minus 0.5. As you go towards in the money, minus 1. As you go towards out of the money, 0. So my friends, teaching is my religion. I believe that God has chosen me to serve people through my knowledge. So I don't go to temples. I don't read scriptures. I only believe that if I can teach well, if I can change life of one person, I am done. My life is done. But at the same time, I'm very strict. I've seen that 50% of you have not revised. If you don't do your revision tomorrow and come to my class, believe me, friends, you've had it. I don't look at age. I don't look at anything. Because this course, you are my responsibility. It's not only about money. It is about your family's time which you're taking to attend this class. And you are going to put in your hard money into the market after this course. So if your concepts are not clear and you're not revising, I am going to be one of the very strict persons to all of you all. So take this as a warning as well as a threat and a piece of advice. All the 3 together. Right? Make sure. And Srivastav sir, one revision is not going to help. You have to see the recording once and then second time you have to read the presentation. Right? If I ask any one of you a question and you're not able to answer, I will catch immediately. I tell you, I have the 6th sense to catch who is in my class and who is not in my class. No pedigree will save you, sir. In my class, everyone is equal. You might be a top shot in your world, but in my class, we all are equal. Right? So please take my advice very seriously, very, very seriously. Because I am responsible for your growth. And if I'm taking the responsibility, you all also have to rise up. Right? This is not a vocational course that you have come to attend and enjoy. We are here to make money. This is serious stuff. Right? The sooner you realize this, the better it is. Good. Yeah, Subramaniam sir, what did you have for breakfast? What did you have, sir? Wow. Lovely. Yummy dosa has made me already hungry for lunch. Right? One way of interpreting delta is the probability of the option strike closing in the money. My user friend, he has not come with his name on. He said, can delta predict probability? Yes. Champak Bhai has bought a 15,700 call with a delta of 0.5. It is telling that there is a 50% chance that Nifty is going to close above the strike price for the expiry. So the delta tells you the probability that there is a 50% chance that on expiry Nifty is going to close above 15,700, which is the strike price. Now it does not tell you whether Nifty is going to close at 15,701 or 15,900 or 16,500. It will not tell you how much it is going to close above or below. It tells you the probability that out of 10 times, 5 times it will close above or below. Venkat Raman sir and Ramakrishna sir have the same question. Ramakrishna sir, have you tossed a coin head or tail? Have you tossed a coin head or tail? What is the probability of a head? 0.5 or 50%. Probability of a tail 50. Now when the market is at 15,700, what is the probability of going up? This is the strike you have got. 50%. What is the probability of going down? 50%. Now, if the probability at the money strike is 0.5 and Champak Bhai is bought in the money call, we know that if the probability of remaining above 15,700 is 50, so if I'm buying this call which is in the money, will the probability be more? Will it be near 0.70%? 80%? So now did you understand why in the money has a higher delta? Because the probability is more. Similarly, for out of money, if I'm buying a 16,000 call, the probability of going towards 16,000 is much less. That is why the delta is less than 0.5. Am I making sense? Am I clear? Vikesh bhai, Rome was not built in a day. Be patient. Be patient. And we will answer all your questions. We will come to each and every strategy. Right? Let us learn. Let us enjoy the learning. I always believe, I keep learning every time when I revise this with my students. I love it. Today, Vikesh bhai has increased my concept of options selling. So each and every student has been a motivator for me to improve my learning. And I have taught more than 1,400 students since the lockdown. Right? Chintan bhai, when I am at the money 0.5 all minus 0.5 at the money put. So when I'm going to in the money, it is 1. When I'm going to out of the money, it is going towards 0. Similarly for the put, in the money minus 1, out of the money 0. Same concept. Graphical pictorial presentation. Am I clear? Are we all clear with it? Good. Somit sir, are you a chartist? Do you have a passion for charting? Good, keep it up. What is delta neutral? So Somit sir, one piece of advice. A chartist should have a mix of artist as a scientist. A chartist should have a mind of a scientist and a heart of an artist. Right? Yes, Nabam sir. How is it going? Delta neutral is a portfolio strategy whereby utilizing multiple positions. So when I create 2 or more position, either buying call, selling call, buying put, buying call, where the positive and the negative delta, where the positive and the negative delta of the total strategy balance out and the delta is near to 0. So when the positive and the negative delta balances out and the overall delta of the strategy is near to 0. Am I clear with this? I'm making a strategy 2 or more legs where the positive and the negative deltas of each leg balance out and the delta is near to 0. Let's take an example. Why do I do this? Number 1, profiting from volatility. Number 2, profiting from time decay. Number 3, hedging. These are the 3 ways. So now we are going to come to making money. Now we are going to come to making money. Right? Number 1, profiting from volatility. When a huge movement is expected, but we do not know the direction of the movement, a delta neutral position is created to gain advantage of the big price move which is going to happen. Big movement, we don't know the direction. So when does the big movement come? Chintan bhai, when? Yes, user friend. Budget, lovely Yash bhai. Election, thank you sir. The right word is event. Whether it is a earning, whether it is a RBI policy, whether it is an election, whether it is a budget, pandemic cannot be an event, right? Company earnings, budget, yes, geopolitical, like Brexit, US elections. So when a huge movement is expected, but we do not know the direction, so can you predict who is going to win an election? Can you predict the company results? No. So a delta neutral position is created to take advantage of the big price move. So examples are long straddles and strangles. What are long straddles? I'm buying a call. I'm buying a put. Right? Both the call and the put are of the same underlying. Right? So if I'm buying Bank Nifty call, I will buy Bank Nifty put. Same underlying, same expiry. So if I'm buying something for the July 29th expiry, I will buy the call and the put July expiry. Both belonging to the same strike. This is the first strategy, long straddle. Both belonging to the same strike, where the delta of the call and put both are equal to 0. So what am I doing? Buying a call option, buying a put option, right? Same strike, same expiry, same underlying. delta of the call, delta of the put should be equal to 0. Which strike has the delta call and put equal to 0? Which strike? Lovely, Somit Bhai. And the money strike, you remember delta of the call 0.5 and the money put delta 0 minus 0.5. So my friends, let's create a delta neutral long straddle. Let us take Nifty, right? Let us assume 15750 call. The current price future is 15750. Let us buy a 750 put, right? Let me go down to the Greeks. Can you see the delta is near to 0? Delta of the call 0.5, delta of the put minus 0.5. So what do you do when you buy a long straddle? I'm buying a call. What is the combined premium? 374, right? 374. So basically, when I'm buying the call, it will be the strike plus the combined premium. What will it be? Strike plus the combined premium. When I'm buying a put, what will it be? Strike minus combined premium. Why? Because I'm paying premium for both the call and the put. So I have to basically add to my call strike and subtract to my call put strike. So what will happen? Ultimately, what will it become? It will become like this. So can you see if there is movement either side in a big way, I will make money. So the market falls. So there are two break-even points. Call plus combined premiums. If you see 15,750 plus 374. So 16,123. Right? Can you see this? Is this making sense? Pramod sir, is this making sense? I'm adding combined premium 374. तो जब मैं कॉल खरीदता हूं तो मेरा स्ट्राइक है 15,750 प्लस 374. Right? So what is the maximum loss when I'm buying a put? Put strike 15,750 minus 374. My maximum loss is the total premium 374 into 75. I cannot lose more than the premium. Can you see this? I cannot lose more than the premium. Am I making sense? Right. Any questions? Good. So now, did you understand? When the market goes above 16,123 or falls below 15,377. So in an event, do you expect volatility? In normal case, can you make money? No. Can you expect such wide movements? No. But in an event, you can make money. Is this clear? So let us do this live example. You are buying a 40 strike call at 3 rupees premium. You are buying a 40 strike put at 2 rupees 50. So what will be your break-even point? Ramakrishna sir, what is the combined premium? 5.5. So what is your break-even point? Jatin sir for the call. Strike plus combined. This is Abhishek sir. I knew people will be confused. So 40 plus combined premium 45.5. What will be for the put? Abhishek sir, strike 40 minus 5.5. 34.5. Is this clear? So you want to take a live example, you want to backtest one strategy. You want to backtest any strategy? Long straddle? All ready? Can we backtest it? How many of you have seen anything? You know, I do webinars with eLearn Markets. Has anyone seen any webinar of mine? Okay. Right. So I had done a webinar on the national elections. Oh, yes, yes, you were there in the golden strategy. I had done a webinar on the national elections. In the national elections, I have made a prediction. So let me take you. One of the predictions I have done, I have backtested the last 4 elections. When was the last election? When was the last election? 2019 May, right? So let me take you there. The election results were announced on the 23rd of May, right? 23rd of May. So 7 trading sessions before that. 1, 2, 3, 4, 5, 6, 7. 7 trading sessions before that, if I do a long straddle on closing, if I do a long straddle on closing, and I hold it maximum till a election date. If I hold it maximum till the election date, what is the result? So my friends, there is something called iCharts. It's a paid site. Here you can get the option chain previous data. So if I want to go down to the historical data, right? I want to check the May 2019. May 2019, right? And I want to check 14th May. When I click this, I'm getting the closing price of the 14th May, 11,241. Now, I know that 11,200. What is the delta of the call? 0.56. Put 0.43. It is slightly delta positive. Okay, no problem. I'm still taking it. It is not exactly delta neutral. So what am I doing? I am buying the 11,200 call at 320, put at 288. Just can you see this? Call is at 320. Right? Can you see the call? 320, put 288. So I'm buying the call at the closing 320 to get 288. So what is the combined premium? 608. So what will be the upper break-even point? Strike plus combined premium. What will be the lower break-even point? Strike minus combined premium. Am I making sense? We have 7 days before the results. On the closing, I have done a long straddle at the money call, at the money put. Okay? Now let us see what happens on the next day. Yeah, Rohit bhai, but it was not very liquid. That is why we took 11,200. You are absolutely spot on. Now, if you see on the 15th, Nifty value 11,177. What is the value of 11,200 call? 292, put 318. So what happened? Nifty fell down, call premium came down, put premium went up. What is the combined premium? From 608, it has come down to 610. Right? Now when I come down to 16th, let us do back testing day by day. What is the Nifty price? 11,285. All 340, put 257. Can you see this? Can you see the combined premium has come down? Now we are losing 10 rupees from our entry point. Are we all clear till here? Can you see every day what is the Nifty has gone up? Call has gone up, but the put has fallen more. Right? Now let us go down to the 17th. Nifty gone up 11,425. 301, sorry, 430 and 207. Can you see this? Nifty is going up, call is going up, put is falling. Can you see the combined premium has gone up? Are we all on the same page? Any questions till here? Now we are back testing a strategy. Right? Now let us go down. 20th. Wow, can you see this? Nifty has gone up by 433 points. 11,200 call, 729, put 73. Can you see this? Now can you see this combined premium? Can you see call has gone up substantially? Put has not fallen to 0. Right, so Ramakrishna sir, I am showing you the back testing result. The onus is on you. If you want, you can book profit any day. This is the end of the day. In the intraday, you might have got more profits. Right? Now let's go to 21st. So this is the way you backtest your strategy. Now Nifty has fallen 11,715. Can you see the premiums have come down? 618,105. The combined premium has also come down. Right? 618,105. Right? Now we go down to 22nd. Right? When I go down, 22nd, 11,200, 684, put 104. 684, 104, 788. Right? Now always remember, whenever the event is declared, if the result is out in the morning, you can hold this strategy maximum 30 minutes after the result. So we all knew the result was declared in the morning, and this call made a high of 900, 840. This was 70. So we could have exited our position at 910, right? But unfortunately, if those people who have not exited, they will suffer a loss. So can you see how this long straddle works? Nabam sir, Nabam sir. We made a delta neutral or a close to a delta neutral position on 14th May. How are we making money in this strategy? Our position was delta neutral. What is delta neutral, Nabam sir? Money made in my call, I will lose that money in the put, right? If the market goes up, call I will make 50 points, put I will lose 50 points. Am I correct? Then how am I making money? So Nabam sir, how am I making money? Okay. Okay. Okay, you remember something? See the slide, please. Please see this carefully. 11,200 delta neutral call and put. Right? Now what will happen if Nifty goes up? Will this become in the money? Will this become out of the money? So what happens? We are making delta neutral only at that price, but if there is a big movement, what will happen? Our call will become delta positive. It will move towards 1. Put will become out of money, head towards 0. The delta will change. Very good, Ramakrishna sir. Delta value will change. Let us do this example. When we made the call and the put, delta of the call was 0.56, delta of the put was 0.44, minus 0.4. If Nifty went up by 100 points, my call would have gone up to 56 rupees. My put would have lost 44. Still, I would have made 12 rupees, right? My call delta is 0.56. So my premium will go up by 56. My put premium will come down by 44. My combined premium will be 12 rupees. Right? So my original 606 plus 12 is 618. Now when the Nifty goes up by another 100 points, my delta of the call goes up from 0.56 to 0.65. That means my call will go up by 65 rupees. My delta falls. Can you see it becomes out of money? The delta falls to minus 0.35. So my put will fall by 35 rupees. Call goes up by 65. What is the combined premium? Going up 30 rupees. So from 618, 30 rupees is 648. So can you see again when market goes up, my delta is going up by 0.8. So that means for every 100 points, my call will rise by 80 rupees. My put delta is coming down by 20, minus 0.2. So my combined premium goes up by 60. So can you see this here? So when Nifty is going up, my call delta is moving towards 1, put delta towards 0. That is why my combined premium is going up. Similarly, if the Nifty would have fallen, my delta of the put would have gone to -1, delta of the call towards 0. So always remember, this strategy will give you money either direction. But if the market remains in that narrow range of 11,200 to 11,400 or 11,200, 300 points range, this strategy will not give you money. This strategy will not give you money. Am I making sense? Did you now understand? So when we are making this trade, it is delta neutral. But if it goes up, it becomes delta positive. If it comes down, it becomes delta negative. Is this clear? Right? Good. Now, my friends, you can say, sir, it might work in 2009. What is a guarantee? It might work in 2014. What is a guarantee it worked in 2014 or not? So let me take you to 2014. When was the election? Anybody was there in 2014? Anyone? This was the election day. 1, 2, 3, 4, 5, 6, 7. If you are made at 6,650 call and put, right? Would you have made money? Yes, this was the election day. More than 10-15% rise. Let me take you to 2009. This was the election day result. 20%. 1, 2, 3, 4, 5, 6, 7. You got 20%. Anybody seen the 2009 election? No one? All new turfs. Okay, Avinash sir has seen. So now let's go one more step further. 2004. This was the election result. Anyone here? 17th May. 1, 2, 3, 4, 5, 6, 7. From 1800 it went to 1400. So can you see last 4 elections this strategy has worked? Big movement. Ramakrishna sir said big movement. Last 4 elections, big movement has happened. Right? So welcome to the first strategy we have done. Subramaniam sir, did I tell you West Bengal? No. Only Central. Right. So Rohit sir, when you are entering, this is your entry point. So your stop loss should be 15%. So plus 608 minus 90. And your target could be 20%. 729 to 25%. So when you backtest the strategy, you will understand your entry and your exits. Right? Good. So did you get this? Delta neutral, long straddle. Is the long straddle clear? Yeah, Vikesh bhai, it has worked wonderfully well with the US elections also. Now we come down to the long strangle. Yes, Kunal sir, how are you doing? So in the long strangle, you're buying out of money call. You're buying out of money put. Both the call and the put are of the same underlying, different expiry, different strike, but the delta of the call and the put combined should be equal to 0. How many of you know that there is an option chain in Opstra? Anyone seen that? Option chain in Opstra? There is this option chain. Now I want to create a delta neutral. So can I see the delta of the call? $15,900 call is 0.37. 15,600 put is minus 0.37. So let me buy a 15,600 put. Let me buy a 15,900 call. Right? So can I see the Greeks? Can I see its delta neutral? What is the combined premium? 128 plus 115. So 243. Right? Now to the call strike, which is 15,900, I will add 243. Right? So strike plus combined premium. To the put, what is the put strike? 15,600. So here, less combined premium. Strike minus combined premium. So when I see here, in the payoff, can you see the difference? In a straddle, we had one single point like this. In a strangle, the call and the put strikes are different. So can you see the total premium is much lesser in a strangle, right? But the break-even points, can you see, are far away. Can you see the total premiums are much lesser? In the straddle, we were paying 374, right? But in a strangle, we are just paying 242. But our break-even points are much far away, right? Much far away. So there is a saying in English, the cup of tea will be sweeter to the proportionate of sugar put in it. हिंदी में समझाता हूं, चाय के ग्लास में जितना ज्यादा चीनी डालोगे उतना मीठा होगा. I will explain this in Gujarati. ચા માં જેટલી ખાંડ રાખશો એટલું મીઠું થશે. I'll explain that in Bengali. চায়ে যত শক্কর রাখবেন মিশাবেন অত মিষ্টি পাবেন. So if in a straddle I'm paying more investment, my rewards will be more than a strangle. So in a straddle, my rewards will be more than a strangle. Am I making sense? But one thing, if a straddle makes money, a strangle will also make money. Abhishek sir, if a straddle makes money, a strangle will also make money. Yes? Right. So let's do this example. Ramakrishna sir, 45 strike price call. You are buying at 2 rupees. And the put, 35 strike put. You're buying at 1 rupee 60. So 45 strike call, you're buying at 2 rupees. 35 strike. So what is your break-even point? Call, what is the strike price? 45. What is the combined premium? 3 rupees 60 paisa. So strike plus 3 rupees 60. What is it? 48.60. For the put, what is the break-even point? 35 minus 3.6, 31.4. Is this clear how to select the break-even points? So when will you make a long strangle? During an event like straddle, you will make a strangle. It is a variation. I don't know the outcome, but I know there is a big movement which can happen on the upside or a downside. Either ways, I will lose money if it stays in a range. Am I clear? Good. Delta neutral. So my friend, what is your homework? Please, who is writing down the homework? Champat bhai, the premium in a long straddle I am paying more. Strangle I am paying less. Premium. Who is writing down the homework? Please type today's homework. Please find out the weighted average change in open interest of 15,500 put. Please type the homework. Please find out the weighted average change in open interest price of 15,500 put, July 29th expiry. Have you typed? Who is typing? Quick, quick, quick. यहाँ पे नहीं विकेश भाई, व्हाट्सएप में होमवर्क डालना है. व्हाट्सएप में. Point number 2. Please find out how will you make money doing the long strangle during budget. How will you make money doing the long strangle in the budget? Thank you, friends. How was the session today? Right. Have I bored you, Ramakrishna sir? So if I'm boring you, let me know. We will have a Cadbury party. When I become boring, we will stop. We will open our webcam. We'll all have a Cadbury. We will enjoy ourselves. We are here to enjoy, sir. Learning is a part which becomes memorable when you enjoy. Right? So we want to make money. We all are here to make money. But we want to enjoy this journey. We don't want to make it very pressurizing. Dheere dheere we'll all learn. I think so. We are all going to learn. If you are sincere, we all make it in life. Whenever you do something good in life, even if no one is watching, we rise a little in our eyes. You know, if you have gratitude and you are helping someone, say with a small piece of food or with the clothing, that gratitude takes your soul up to the next level. Right? I'm very grateful to God that He has given me this opportunity to do with you all. Right? So thank you all for being with me in this session. Tomorrow is a fresh start. Right? Tomorrow is a fresh start, and tomorrow we are going to do that money making strategy, which we are going to trade throughout once we learn tomorrow. All the best. Please do your revision. We will make it. God bless you all. See you tomorrow with a fresh mind. And Anand sir, let me know what did you have for breakfast tomorrow morning. We will enjoy. Bye-bye. See you. Take care.